Good afternoon. Welcome to the Monetary Policy Stance and Monetary Policy Report press briefing. Let us welcome the following: Monetary Board Chairman and Bangko Sentral ng Pilipinas Governor, Governor Ellie M. Remolona, Deputy Governor Francisco G. Daquila Jr. of the Monetary and Economic Sector, Senior Assistant Governor Iluminada T. Sicat of the Monetary Policy Subsector, and Officer in Charge Dennis D. Lapid of the Department of Economic Research. Governor Remolona will now deliver the statement on the monetary policy decision. Governor?
At its meeting on monetary policy today, the Monetary Board decided to keep the interest rate on the BSP's overnight reverse repurchase facility at 6.25%. The interest rates on the overnight deposit and lending facilities were thus retained at 5.75% and 6.75%, respectively. Latest baseline projections continue to show a return to inflation target in the fourth quarter of 2023, despite a generally higher path for inflation relative to the previous forecast from the monetary policy meeting in June, reflecting mainly the impact of higher international oil prices. Average inflation for 2023 is seen to reach 5.6%, while the average inflation forecast for 2024 and 2025 now stand at 3.3% and 3.4%, respectively. Meanwhile, inflation expectations for 2023 have remained steady, while those for 2024 and 2025 have declined slightly. Nonetheless, the balance of risks to the inflation forecast continues to lean towards the upside. Potential price pressures are linked to the impact of possible higher transport charges, higher minimum wage adjustments, persistent supply constraints on key food items, and the effects of El Niño weather conditions on food prices and power rates. Meanwhile, a weaker than expected global economic recovery remains the primary downside risk to the inflation outlook. The Monetary Board also recognized the challenging outlook for economic growth as the weaker GDP outturn for the second quarter of 2023 reflected a broad-based slowdown in domestic demand. Household consumption slowed due to elevated commodity prices, while government spending contracted relative to the previous year. Given these considerations, the Monetary Board deemed it appropriate to maintain monetary policy settings to allow a moderation of inflation, even as authorities continue to assess the emerging risks to inflation outlook. Authorities noted that the strength of economic activity going forward is likely to moderate as pent-up demand wanes and the full impact of prior monetary policy tightening continues to manifest. At the same time, fiscal impulse through programmed spending could support the growth momentum. The fiscal authorities are now pushing agencies to ramp up spending to fulfill the 2023 public expenditure program. Sustained non-monetary measures remain crucial in addressing lingering supply-side pressures on prices. The BSP remains prepared to respond as necessary to safeguard the inflation target in keeping with its primary mandate to ensure price stability. End of statement.
Thank you, Governor. The Governor will entertain a few questions from the BSP Press Corps who are here with us today. This portion of the Q&A will be followed by the Monetary Policy Report. May we remind our media friends to first state your name and your media organization before asking your question. We have two microphones on the floor right now.
Good afternoon, Governor.
Good afternoon.
We're wondering if
Name
you
your
could.
name.
Sorry, I am Ditas Lopez from Bloomberg News. We're wondering
Yes.
if you could share the voting for the decision today, and if the vacancy in the monetary board has any impact whatsoever. I ask because if there's a split vote, who will be the one that will break that? Thank you.
My friend, normally we don't tell you how the voting went. But this time, I guess it's obvious. No? Because, we need 4 votes for the monetary policy decision, and there are only 4 of us. So you can do the math.
Thank you, Governor. Thank you, Ditas. Any other questions?
Lawrence Sakawili from Philippine Star. Gov, could you expound on the reasons behind the increase in the forecast for inflation for the next 3 years?
The increase in the it's only a slight increase. Mainly supply side pressures. International oil prices is the main factor, I would say. Maybe Francis can add to that.
So as stated in the policy statement, the main reason for the upside uh, adjustment of the baseline is the uptick in the global crude oil prices that we've seen recently, as well as in the implied path of oil that's reflected in the futures prices. We've also taken into account the higher inflation nowcast in the near term, as well as the higher than expected minimum wage adjustment, and also the impact of recent developments in the US dollar. So,
Let me just add that even when we project slightly higher inflation rates compared to the previous forecast, the basic story remains the same. We have declining inflation rates, and we expect to be within the target range in 2024 and 2025. That story hasn't changed.
Thank you, Governor. Thank you, DG Dakila, and thank you, Lawrence. Are there any other questions?
Good afternoon to our officials. Good afternoon, Governor. Gov, in your
Your name,
statement,
please.
sorry, I'm Andrea Calonzo from Bloomberg. Gov, in your statement, you cited a challenging outlook for our growth and that it will likely moderate. So, given the fiscal measures that you already cited, is there a need to support this with monetary actions going forward?
Not at the moment. For now, we don't see monetary tightening as having been a factor in the lower growth forecast, especially in Q2. The lower Q2 number seems to be from special factors, not from monetary tightening. I think the effect of tightening comes with a longer lag than would be expected, than we would expect to affect the Q2 number.
Thank you, Governor.
So,
Additional
given that,
question. Go ahead, please.
so so right now, in the past statements, even DG Dakila has been saying that you're still ready to resume tightening for if necessary due to upside risks. Is it
Yes.
still the case?
Yes, it's still the case. So we're ready to tighten. Looks like we need to tighten. We're following the data.
Thank you, Andrea. Thank you, Governor. Yes.
Gov, are there plans to further lower the RRR, considering that you have a maintained interest rate steady for the third straight meeting?
For now, we don't anticipate lowering the policy rate. For the reserve requirement, we intend to lower the reserve requirement, but we don't know when. I don't think it makes sense to lower the reserve requirement while we're still in a tightening mode. They're not consistent. One is about inflation, and the other one is more about efficiency in the banking system. But the reserve requirement distorts the allocation of credit to the banking system.
Thank you, Governor. Thank you, Lawrence. We can go to the last question now.
Good afternoon, to our officials. Good afternoon, Governor. This is Keisha Taasan from Business World. From the statement, I think you intend you intend for policy rates to remain elevated for the rest of the year, and you don't see any easing in the short term. Given that, Governor, do you think the economy would be able to weather elevated interest rates, given that we had seen a slower growth in the second quarter?
For now, we don't see any easing, at least not in the next meeting. The rates are not that elevated. They're still low enough to not be a factor in growth.
Thank you, Governor. Thank you, Keisha. At this point, we would like to request OIC Sir Dennis D. Lapid to share with us the August 2023 Monetary Policy Report.
Good afternoon. So let me just take you through the highlights of the latest monetary policy report, which we will be publishing and will be available for download on the BSP website by tomorrow, August 18th. So that report will contain a detailed discussion of the points we will be presenting this afternoon. So the following are the key considerations in the discussion of the Monetary Board and the monetary policy decision at today's meeting. Firstly, in the next slide, it's important to say at the start that this is a major update or a full forecast update, because for this meeting we have the GDP data release and also the CPI. So we fully updated our forecast for this round of monetary policy assessment. So as you can see, we revised our forecast upwards, as was discussed earlier as well. But the overall path remains the same. So we still expect a deceleration in inflation towards the target by the fourth quarter of this year, and then further down for next year in 2025. So the latest, just to go through them quickly, the latest projections by the BSP are now higher compared to the previous round. The forecast for 2023 is 5.6% versus 5.5% in the main monetary policy report that we published. For 2024, it's 3.3%. So above the 2024 forecast in the May meeting. Back in May, we didn't yet publish the 2025 forecast, so we only started in June. The latest forecast for 2025 is 3.4%. So firmly within the target, the government target range. So these forecasts already incorporate the latest CPI release and also the second quarter GDP data, along with other high frequency data that we normally include in our forecast. Then also, as was discussed a little earlier, the upward revision in these forecasts are due to the following factors: the sharp increase in Dubai crude oil prices in recent weeks. We've incorporated additional the impact of the additional price pressures into our inflation nowcast for the next few months. we've also incorporated the effect of the higher than expected minimum wage adjustment and also the recent movements of the peso. These were partly offset by data showing slower GDP growth and also a slower outlook, as well as lower assumptions for prices of global or international non-oil commodities for both this year and for next year. So, and we show you the path for the inflation forecast in the next slide. As you can see, so as the governor was saying, inflation will go back to the target by the fourth quarter of this year, and that will make it possibly around 18 consecutive months of above target inflation. The projected inflation will go to the midpoint of the target by the fourth quarter, and then further down to close to the lower end by the first quarter of next year. And then shortly thereafter, because of factors like there will be positive base effects that will drive inflation slightly upward for next year, along with the impact of higher crude oil prices and also the lagged impact of the minimum wage adjustments. So we expect inflation to go up by next year. So there'll be a slight upward trend. Then as we made clear in the statement also, in terms of the risk or the balance of risk to the inflation forecast, if you'll notice, the bands above the central projection or the dark line in the middle are much thicker on the above the dark line than below. So the risks are seen as still very much on the upside for this year until 2025. So the upside risks are the following, which we enumerated in the statement also. Increased domestic prices of key food items that are still facing supply constraints, the potential impact of higher transport charges, possible higher than expected minimum wage adjustments in areas outside of NCR, and also higher power rates owing to the recovery of power generation costs. And the main downside risk is still the impact of a weaker than expected global economic recovery, because right now the outlook for global growth is still weighted towards the downside. So this forecast update also means that we've updated our internal projections for GDP. And as you've heard, the second quarter GDP reflected data reflected a broad-based slowdown in domestic demand, and accordingly, our GDP growth forecasts have been adjusted as well. And some of the factors that we looked at are, apart from higher crude oil prices contributing to slower domestic growth, we also incorporated the adjustment in global GDP and the global GDP outlook for 2023. And next, we highlight our latest survey of inflation expectations. These are the mean forecasts that we get from external forecaster or professional analysts who forecast the macro variables for the Philippines. This is from the August round. So this was done from August 5 to 9. So this survey presumably incorporates data from the CPI, July CPI release, but did not yet reflect the second quarter GDP release. But based on this survey of 26 economists in the private sector, we were seeing an unchanged mean inflation forecast for this year at 5.5%. And a slightly lower forecast or mean forecast for next year, 3.5%, and a further decline to 3.4% by 2025. So we interpret this as suggesting that inflation expectations are still broadly anchored. Analysts expect inflation to continue easing in the short term, and these are largely attributed to some negative base effects. But they also see the inflation outlook as still being tilted towards the upside, mainly because of supply side disruptions, and in particular, arising from the impact of El Nino. Some of the upside risks to inflation are associated with high prices of basic goods, particularly food and oil, as well as services, due to supply side factors, and also the adverse impact of trade restrictions on selected food items, as well as the likely impact of the oil production cuts by OPEC member states. The main downside risk cited by some analysts include the lagged effect of tighter financial conditions, which is also expected to temper inflation. So briefly, just to summarize, the following are the main considerations that went into the decision at today's monetary policy meeting. Firstly, the emerging outlook for inflation supports a pause in monetary action. However, the risks are still seen as being leaning towards the upside in the near term. And this requires continued readiness to take necessary action on the part of the BSP. So the Monetary Board deemed it appropriate to maintain monetary policy settings to allow a continued moderation of inflation, even as the BSP continues to assess the emerging risks to the inflation outlook. The weaker GDP outturn in the second quarter reflects a broad-based slowdown in domestic demand. And so there we noted the slower household consumption as well as a contraction in government spending. But this is also an expected consequence of monetary tightening over the past year. The bulk of the impact of which is expected to come in 2024. The strength of domestic activity, as was noted earlier, is likely to moderate as pent-up demand or the impact of pent-up demand on domestic activity gradually recedes. But at the same time, the Monetary Board noted that fiscal support through programs spending remains crucial in propping up the growth or keeping up the growth momentum of the economy. And at the same time, non-monetary measures of the government or continued efforts on this front will help to address inflation pressures and supply constraints that will affect that will allow sustained decline in inflation. And as was earlier made clear, the BSP continues to emphasize its readiness to take necessary action whenever the data demands a response to inflation pressures. So those are the highlights that you'll find in the monetary policy report that we will be publishing by tomorrow, and will be available for download from the BSP website. Let me just quickly add that aside from the discussion on monetary policy, the report will also include some box articles that may be of interest. So we include an article on, apart from monetary policy developments, there's a box article discussing goods and services inflation in the Philippines, as well as discussion of the refinements that we are doing in terms of monetary operations. And so that we will stop there and we look forward to your questions. Thank you very much.
Thank you, OIC Sir Dennis Lapid. We will now proceed to the questions from our media friends and market analysts. For any additional questions that you may have, you may send them through our live Facebook broadcast or message us through text, Viber, or Messenger. So at this point, we will entertain questions that have been sent to us in advance by market analysts and reporters, as well as online questions. So for our questions sent in advance, we have one from Sir Emmanuel Lopez of the Colegio de San Juan de Letran. He asks, considering the current stand of the economy, where the inflation rate is being aggravated lately by the peso depreciation, is it not high time for the Monetary Board to control the value of the peso vis-a-vis the US dollar?
thank you for the question. We remain supportive of market-determined exchange rate. And this is the best framework that allows us to concentrate on the achievement of our inflation target. So it's an essential component of the inflation targeting framework. Actually, as we've already been emphasizing, um, following our shift to inflation targeting and our commitment to market-determined exchange rate, we've seen that the sensitivity of inflation to exchange rate movements has gone down. That means that we can commit to uh, uh, having a market determined exchange rate without worrying too much about our ability to achieve our inflation target. And it then becomes a benign cycle because as market participants become more accustomed to seeing day-to-day changes in the exchange rate, then that supports a, uh, a lower sensitivity of price decisions to decisions in the exchange rate, rather to changes in the exchange rate. Just to give an example, in the 1980s, it used to be that if you saw a movement in the peso dollar rate, you could see that you can adjust your selling price accordingly because you know that that movement will be maintained because it's a managed exchange rate system. Now that's no longer the case. So if you're too quick in adjusting your selling price, then you may actually lose out in terms of competition. So, but as we said, the BSP retains the option to go and intervene in the foreign exchange market should market conditions warrant it. And this is what we've seen in the during the episode in the third quarter of last year. And at that, to recall, during that time, there was some apprehension that the peso may be moving into uncharted territory. And by the actions of the Monetary Board, the adjustments in the policy rate, as well as participation in the market, we were able to stabilize the peso. So rather than having direct control of the exchange rate, then that would be the best option to keep to market determination of the exchange rate with the option of intervention should there be disorderly developments in the market.
Thank you, DG Dakida. For our next question, we were sent a question by Sir Sanjay Mathur. Unfortunately, that's a question best directed to the national government. So for our next question, a question from Michael Ricafort, Chief Economist of RCBC. He actually has two questions. This is his first question. What is the latest view on the possible further cuts on the bank's RRR in the coming months? Thank you. I think this was a question that was answered earlier by the governor. Yes. And then his next question, the current interest rate differential with the Fed is at 75 basis points, among the narrowest in recent memory. In your view, would this be sustained or become a new normal in view of the potential impact on the exchange rate?
This is a question that we've often given our views on. again, there are very uh, significant differences between the situation now and where we were during the latter half of last year. For one, last year, inflation was still on the uptrend. So we have to be very mindful of developments in the Fed and the consequences on the exchange rate and our ability to meet the inflation target. Now, as you can see in the outlook that we have given for 2024 and 2025, we should be comfortably within the inflation target band. And actually, the assessment remains that we should be back to within the 2 to 4% band sometime in the fourth quarter of this year. And it can even be earlier, perhaps towards the end of the third quarter. So likewise, the situation in the Fed is very different because last year the Fed was just beginning to embark on the policy tightening cycle. And now the market is expecting that perhaps the Fed will have one more episode of an increase in the Fed funds rate. But actually, if you look at futures prices, it's already flat. And then the Fed may begin loosening up sometime next year. So again, it's not a one-to-one comparison. And what we can say there is that the decisions on the policy stance will be looking more and more into domestic considerations. But again, as has been emphasized in the policy statement of the board, should the conditions warrant policy action by the BSP, then the BSP is always ready to deploy its instruments.
Thank you, DG Dakila. For our next question, this is from Devalika Sarkar from ANC Research. She asks, my question is, do you see GDP growth meeting the government's 6 to 7% target this year? What is your assumption for oil prices?
With respect to the growth targets, again, I refer to the recent press release of DBCC, keeping the 2023 growth targets and emphasizing that it is achievable with the drive for accelerated spending of government agencies. And likewise, one other factor that was cited is the expected further deceleration of inflation for the second half of this year. As inflation goes down, then the purchasing power of the consumer should go up. And so that should support consumption and spending. Actually, if you look at the Q2 GDP numbers, it was a surprise to everyone. But if you look at the various components of that outturn, very striking is the contraction of government spending by about 7%. So to some extent, the base effects may be present there, but also it highlights the need for different government agencies to ramp up the spending in line with what is that program. So now that the attention is there, then we can expect further improvement in the spending performance of government, national government agencies. And if you look at the different contributions to growth, the -7% is contributing uh, a significant to the significant amount to the growth out there. I think it's around -1.3, something of that magnitude. So you see, if government spending had just been flat, it would already have added more than a percentage point to economic growth. Perhaps we can check later on the actual. Also, it's correct. It's -1.3. And then if government spending had actually been positive, even moderate positive, then the outturn would have actually been significantly higher for the second quarter growth. So I think that illustrates the cruciality of government spending in achieving the growth target. With respect to the second part of the question on the assumptions on oil prices, again, we emphasize that these are just based on the latest market expectations, futures prices. And so for 2024, we're seeing that this is for Dubai, it can be at around $82 and about 30 cents per barrel. And that should moderate in 2025 to around 77 or $78 per barrel.
Thank you, DG Tequila. We now go to another question from Michael Ricafort, of Chief Economist of RCBC. Given the weight of rice prices close to 10% of the local inflation or CPI basket, how will the impact of higher local and global rice prices look like on headline inflation? Thank you.
Thank you. Again, that has already been incorporated into our risk matrix. Not in the baseline forecast, but along with the baseline, we're looking at various scenarios. And even if we combine that with some other risk factors, it's not enough to cause us to breach of the inflation target in 2024. Of course, it still is a factor of the magnitude of the shocks. So if, for example, oil prices go up again to levels that we saw following the onset of the war between Russia and Ukraine, where prices were hovering at about around $100 per barrel, then that would be a scenario where again there could be some breach of the inflation target. But those are scenarios that are not very likely. So in our analysis, we're much more comfortable that we will be within the target band for the policy horizon, over the policy horizon.
Thank you, BG. We have a question from Ms. Raisa Rasid of JP Morgan. Is the U.S. federal funds rate a factor in the MB decision in terms of interest rate differentials with the US? Would you classify the current monetary policy settings as restrictive?
Okay. I think that was the first part has already been answered on the impact of the Fed. With respect to the second part, again, that has already been answered by the governor earlier when he was answering the questions from the press. The current monetary policy settings are not really that restrictive with respect to growth. Actually, as I've already explained, when you have a ramp up of government spending, then growth numbers should significantly go up. And given the lag in the impact of monetary policy, it's actually too soon for the uh, adjustments to have taken the toll on the program.
Thank you, DG. For now, we will shift to questions here from our reporters present. I believe you have a question from the floor. Yes.
Hi, sir. Good afternoon. Kai Ordinario from Business Mirror. I just wanted to ask regarding the commodities that you are monitoring. What would these be that could trigger the BSP to tighten, or are there specific commodities that you're looking at? Like, for example, there was mention of rice. Would that be one of them? And thank you.
All of those are the commodities that are included in the consumer basket. Of course, rice is something that we look at closely because rice is a significant component of the basket. But the good thing is that the interagency committee on the inflation and market developments, I think, is monitoring all of these commodities closely, and any developing shortages should be met by prompt action by the different government agencies. So this is what we mean when we support the timely implementation of non-monetary measures. Now, some other commodities that we monitor would be, of course, oil, because the Philippines is significantly importing the oil, and the some total of all others would be in terms of world non-oil prices. And the good thing about that is that in the latest assessment of the IMF, the World Economic Outlook, for the non-oil commodities as a whole, there could actually be a not just a deceleration, but a fall in prices. So on the average, that should fall by 4.8% for this year and 1.4% for next year, and then about 0.5% for 2025. That is the outlook coming from the IMF. So that should help to mitigate the impact of the higher prices of oil.
Thank you, DG. For our last question this afternoon, we received two from Ruben Carlo Asuncion, Chief Economist of Union Bank. He asks, what is the optimal interest rate level you are seeing considering the uncertainties ahead? And two, a level that growth will not be sacrificed?
Again, we've often emphasized in the past communications that rather than communicate to the so-called optimal, or in some countries they call it the neutral rate of interest. Rather than communicate through that, we do that through the inflation outlook, because it's clearer. Rather than talk about neutral rate of interest, it's a little bit more technical. Everyone can relate more to the how fast prices are increasing. So the inflation outlook we give, and then what's very important is how that outlook relates to the target. Is it above target, within, or below the target range? As to the second part of the question, again, as emphasized in the BBCC press statement, the growth numbers for this year should be achievable.
Thank you, Governor Aquino. Since there are no more questions, we would like to thank everyone for their time and attention this afternoon, including those watching us live on our FB page. We would also like to remind everyone that the Monetary Policy Report will be available on the BSP website tomorrow, the 18th of August, Friday. This ends our Monetary Policy Stance press briefing. I'm sorry. Yes, Governor.
Just to mention, although this is talks na yung ano, di ba?
Yes.
Okay. Just to mention, yung sa PowerPoint kanina, yung El Nino impact should be medium. Hindi siya high. Hindi lang na edit pa. Kasi meron ng mga measures to address yung El Nino. Kaya ang assessment namin is just medium. So please just check okay.
Thank you, Governor. So at this point, we would like to thank everyone again. This ends our Monetary Policy Stance press briefing. Maraming salamat po.